Hello and welcome to our end of August update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple battle-tested methods of investing that require just one adjustment each month to protect and build our wealth. I'm David Ye, author of my book, The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easy to calculate and adjust each month, for those who are new to concepts in this book, or for those who are new to investing in general, this video will try to clarify what I do each month. Feel free to follow along every month until you get the hang of it. This month we'll cover our question of the month, and boy is it a doozy. Over the last week and a half I've spoken to several of you, and now with this video I get to illustrate what I mean. Then we'll update what's going on with the 20-month moving average system, and then we'll review our adjustments for the MRI system. Then we'll briefly go over the rules for the 25% trailing loss strategy for stock tips. So the question of the month, what's up with the stock market? Or rather, what's down? The major stock market indexes have lost more than 10%, although they've come back up somewhat last week. The news are all over this. Some saying it's the beginning of a major crash, others saying it's a great market buying opportunity, people blaming this on China, from its Tianjin chemical plant explosion to its currency devaluation to overall economic instability due to oil prices. What should I do? The short answer, follow your rules. I've been asked this question from people who have read my book to people who have just heard I wrote a book but haven't read it yet, and the answer is the same. I detected nervousness in their voices and then asked, what was your plan in getting in? You had a reason for getting in the first place, right? And as long as the markets were going up, the plan was to stay in. But what was your plan on when to get out? What criteria must be met? How would you know if you were wrong in getting in? See, most of us have been trained by money managers to do something called dollar cost averaging. By buying at periodic intervals, no matter if the market goes up or down, we mitigate risk somewhat. It's a simple one-rule strategy that helps mitigate risk, so that's why I included it in my book. Here's how it works. You take a fund, let's call it XYZ, and it starts at $10 a share. It falls to $5 a share, and then it goes up somewhat to $7.50 a share. Well, that looks horrible. A stock or fund that drops half its value doesn't even break even. Watch. If in this example, every period you bought $100 worth of this fund. $100 worth of this fund. Over here, $100 worth of this fund. When the fund was $10 a share, you get 10 shares. When the fund was $5 a share, you get 20. When the fund was $7.50 a share, you get 13.333 shares. Add it all together, you have 43.333 shares. You put in $300 total. At $7.50 a share, you have $325, even though the fund never even broke even. This is because if you're forced to buy shares when they're cheap, you automatically buy more shares for the same amount of money. Thus, when the markets go up, the investor is happy because the account goes up in value. When the markets go down, the investor is happy because the investor will be buying more shares for a bargain price. One rule, happy when the markets go up, happy when the markets go down. No self-doubting what should I do questioning. This one rule system mitigates risk by reducing the average cost of shares in the fund over the long term, increasing the chances of profit in the future. One system, one rule. If the markets start to turn down, there is no need to ask, what do I do now? Since there's only one action. Buy again, as usual. What about the 20-month moving average system? As you see, this month, the S&P 500 index barely closed above the 20-month moving average. By now you know the mantra. Know the rules of your system, then follow your rules. If you already know your rules, there shouldn't be any, oh my god, what should I do now questions in the middle of the month. The rules say, take the price at the end of the month to make this calculation and then act on it. No wondering if it's the right thing to do. Remember, once your money is in the markets, your limbic system takes over and distorts your perception of the markets. You will see buying opportunities when there are none, and you will see panic when there is none. The objective data says the markets went down this past month, but not down enough to meet criteria to get out of the S&P 500 index. But wait a minute. I've been asked, the markets plowed down below the moving average 2 weeks ago. Why didn't we act then? To answer this, let's first make a distinction. The formula requires only the end of the month price to make its calculation. So we need to only look at the end of the month data. Just like how if you watch the news or listen to the pundits, they will bombard you with all this extraneous information designed to pump up your heart rate and entice you to tune in to listen to more. Same with looking at too much data. This data below looks like a jagged version of the data on top. Some of you know this chart down here is called a bar chart and gives us a lot more information than this top chart. We're going to focus particularly on here, where the bar charts not only touch but power through the moving average, even though they didn't show up on the simplified chart. Now, first of all, the bar chart consists of something called a price bar. In our example, each bar represents 1 month, with this small bar jutting out to the left representing the opening price on the first day of trading of the month. This top of the bar representing the highest price of the month. This bottom of the bar representing the lowest price of the month. And this bar jutting to the right representing the closing price or the last price of the month. You can see graphically, this one bar tells us a lot more information about what happened to prices during the month. It started out here, jiggled around, up and down, ended here. So here's how the bar chart is put together. 1 month, we get a bar. Next month opens roughly at where the month closed the last month. Jiggles around. This one doesn't go up that much. Next month, another bar. Starts roughly same place, jiggles around, goes up more. It's making a new high. Next month, another bar. It crashed, but it didn't crash and stay there. It actually fought back up, and now it ended up a little bit higher, although it's still kind of low compared to previous bars. Next month, there was kind of ho-hum. It started same price, went up a little bit, down a little bit, ended up a little bit higher. And then all of a sudden, next month, it gapped up. See how the opening price is so much higher than the closing price? That happens often with individual stocks, especially on the daily time frame when unexpected news comes out overnight that either directly or indirectly might affect the value of the stock. If you heard that sentence correctly, you know the key word is might, as in it might happen. That's the whole point about markets. Everyone has an opinion about where the markets will go. Some use valuation models, some use news, some use technical indicators. Most use gut feeling, and yes, that means ultimately the collective herd mentality and overall gut feeling mood of the market drives the market. One proof are these frequent gap ups and gap downs. So here we see the market gapped up, tried to go higher to new highs, but then went lower again, but not quite as low as the last month. And another month, and so on. And this green line links all the closing prices from month to month. Do you see how much smoother this line is? It takes out a lot of the drama of the markets and concentrates on arguably the most important price, the closing price. Now, just an aside, arguably the most important closing price is the Friday closing price of a weekly time bar, just because day traders and institutional traders hate to leave open positions on over the weekend, just in case there are these gap ups and gap downs over the weekend. Which is advantageous to us since we use monthly data, so our data is not so rigorously controlled by the professional traders. So let's look up close and personal at one of these bar clusters. Back here in September, for 3 months, yes, 3 months, the index poked through the 20-month moving average line. But each time it closed above the line, and the rest is history. The markets kept on going up until finally year 2000, where it poked down for 2 months, before it finally closed below the 20-month moving average, and that's when we finally got out. In fact, if you look just at the closing prices, you wouldn't be worrying in the middle of the month about falling prices. One more note, if you look at this month's graph, yes, we did dip below the 20-month moving average. However, we rallied just a smidge above the moving average. Let's take a closer look. Last month, we had the S&P 500 index fund price at 194.32, which is 7.1% higher than the 20-month moving average. This month, the S&P 500 index dropped down to 182.58, which is a hair above the 20-month moving average of 182.28. 0.2% above the line is a hair, but it still counts. We are still above, so we stick with the stock this month. You can see how the big bear market we had 2 weeks ago shows up in the grand scheme of things in this 20-year chart. Yawn and wait until next month. I know at least a couple of you jumped the gun 2 weeks ago and sold. The few times I jumped the gun and adjusted in anticipation of the markets, I've been proven wrong, or the system was proven right. However you want to look at it. Think about it this way. If next month the markets move up, the ones who sold will wish they didn't. However, if the markets continue to tank next month, the ones who stayed in this month will just get out next month when we meet criteria. Next system. I'm learning to put in a blank slide here to make sure that you understand that we're done talking about the 20-month moving average system. And now we're going to talk about a completely different system with its own rules on how to mitigate risk. Don't mix the rules up. Don't mix the systems up. The MRI, or monthly rotation investment system, here it is. Here we go. We take this month's price, divide by last month's price, and we see that this month we have a clear winner, their inverse fund. Yes, now we rotate a quarter of our portfolio into inverse fund. And here's a graphical representation of how relatively flat the markets have been until August 18, and all of a sudden, markets tanked, inverse funds took off. So last month, we were already a quarter in the inverse fund. If we sell 1 quarter worth of our portfolio of the S&P 500 index fund and buy the inverse fund, we would be roughly 50% inverse fund and 50% index fund. And since one inverse roughly cancels out with one index fund, we can safely be in all cash right now. And for those of you who were 50% cash last month and 50% index fund, feel free to just sell this index fund and you'll be in all cash right now. Next system. Once again, I list the rules for the 25% trailing stop system for those of you who like owning individual stocks. This past month, I had 3 positions of stock get stopped out, and I know a couple of you have as well. Rather than lament that you just got stopped out, think of it this way. If the stock was volatile enough to lose 25% off its high, thank goodness you got stopped out. Imagine if it tanked 35% before you noticed, 50%. I know colleagues who still hold on to stock that have lost 90% or more and are still crying in their oatmeal, which is a silly thing. A lot of us have our egos and our identity tied to our net worth. Talk about emotionally tied to investments. Loyalty works in intimate relationships, but diversity works in investments. There is no genius to making money, and if you lose, know that as long as you learn from the experience, you're going to be growing into a more effective investor. So, in this month's video, I answered a set of questions I got a lot during the last 2 weeks. You watch the markets, you watch the news, the intra-month or intraday data is entertainment and that it sure gets your heart rate up. But if you're using a monthly system, remember only the end of month price matters. If you're using the trailing stop method, let the trailing stop automatically take you out of the position to save you. The main reason people get nervous about the markets is because they have no plan. They get in without a plan and they don't know how to get out as they watch their funds melt away. Keep those questions coming. I know I talk to several of you personally each month, but for those of you who only heard about me indirectly, maybe you got a copy of this video forwarded to you by a well-meaning friend or colleague, here are ways to get in touch with me. And until next month, invest safely.